Welcome to the third webinar in our series of financial wellbeing for women. Today we'll be focusing on our financial situation after we've finished working and why it's important to plan now for life after work. The concept of a traditional retirement is changing, so we use the term life after work as this fits in better with our peers and our clients' lifestyles. Why is this subject particularly important for women? Well, a report by Scottish Widows launched at International Women's Day in March this year highlighted a pension gap of £100,000 for a female in her early 20s compared to a male of the same age. We all now have a higher life expectancy, and with women living on average for 4 years longer than men, their pension savings have to work harder or their pension pot might need to be bigger. And why is this such a difficult topic? Well, pensions is a big area with many complexities. Jargon and acronyms are frequently used by the industry, so it can be difficult to understand, and rules surrounding contribution limits are constantly changing. Tonight, we'd like to share our experience of helping clients plan for life after work and highlight some steps to closing the pension gap for women. Hopefully, along the way, we can give a better understanding of some of the terms that are frequently used, and we'll have time at the end to answer some of your questions. As we go through, please put any questions into the Q&A feature and I'll pass as many of them as possible to our speakers. So I'm joined this evening by Bronwyn Horton, a financial planner, and Rachel Winter, Associate Investment Director. Okay, to start with, let's think about our own situation, and we've got a quick poll to help us do this. If I just launch this. This is just going to ask, do you know or have you planned how much you will need once you finish work? I think that pretty much everybody's answered now. So, a couple more still putting their answers in. Okay, so I'll end the poll here and I'll share the results. Okay, the results are really interesting because more than half of you have actually planned, or you know how much you will need in your pot once you finish work, but almost half either don't know or haven't thought about it. So before we can understand how much we might need after work, we need to know the main ways to fund this. So to start with, Bronwyn, could you give us an overview of the main ways that people fund life after work?
Yeah, thanks, Sarah. So there's a huge number of ways that people can fund life after work. And tonight we're going to concentrate on pensions as one of the main methods. So I'd like to start with a very quick overview of the types of pensions. So firstly, starting with the state pension, there's a little bit of a misconception when it comes to when this will start. So a majority of people think that it actually starts at age 65. Now, the age has been increasing recently. Currently, at the moment, it's age 66 that the pension will start, and that's for both men and women. That will increase to 67 between 2026 and 2028. And it's also scheduled to increase to 68 after this, although the timeline hasn't been released at this stage. So entitlement for your state pension really depends on your national insurance record. So that's how much national insurance contributions you've made. So to qualify for the full amount, now the full amount is £179.60 per week. And to qualify for this, you need 35 years of full contributions. So if you don't have this, the minimum you'll need is 10 years of full contributions before you start to receive a pro rata of this amount. Now, two things that everyone on the call on our webinar tonight can check is firstly your age of eligibility. So when will you potentially start to receive your state pension? And then secondly, how many years you've already accumulated. Now, this second link that I'm going to pop in the chat very shortly will show any gaps in your contributions. Now, the reason why this is important is that if you do have gaps, you can actually go back and fill a few years as well. And for a majority of people, the state pension of just over 9,000 is actually not enough to live off. So therefore, a lot of people do subsidise this the state pension. And what we want to concentrate on tonight is the pensions which you can you have a little bit of control over or influence while you're actually building up your pots. So with pensions, there's a lot of jargon, as Sarah said in the opening, and there's often a lot of terms which are used in a similar fashion for the pensions. I'm going to explain about two main ones tonight. And the first is what we call a direct benefit pension. Now, this is also known as a final salary or a career average pension. And it's what we traditionally call a very old type of retirement pension, where a person will receive a set amount. This could be adjusted for inflation for the rest of their life. Now, these are becoming few and far between. The second type is what we call a direct contribution. Now, they're also known as money purchase pensions or personal pension plans. How these work is that the pension pot that you'll end up with once you've finished work, so once you come to retire, is solely made up of what you've put in and how it's performed. So once you start drawing down on this, and you can wind it down to zero, you could actually run out of income, as opposed to direct benefit, which will continue on throughout your life. So one thing to note is that individuals can contribute an annual allowance. Everyone's got an annual allowance up to 40,000, where you can make a contribution and you can receive tax relief. Initial contributions will receive 20% tax relief, although you could actually receive further in certain circumstances. Now, the actual amount that you can contribute will depend on what we call your relevant earnings. Now, direct contribution pensions can be set up through work, where an employee and an employer make contributions. However, the employer might cap how much they contribute, or the pension provider might sort of restrict if you can make additional contributions. So with auto-enrolment starting back in 2012, both an employee and an employer now have a minimum contribution of 8%. Now, that could be 4% each, or it could be 3%, one for the employer, or 5%. So many people decide that actually that they need to contribute more, so they want to contribute on top of their workplace pensions. They may be in a position to do so by taking advantage of their annual allowance and the tax relief, or by setting up a personal pension as well and contributing. The whole reason for consolidating pensions as well, so you might have a number of workplace pensions, and you might decide to actually set up that personal pension and consolidate in one sort of pension pot. Now, another option or another way of actually setting up a personal pension is something called a SIP, which is a self-invested personal pension. And it is a type of DC pension, so it's a type of direct contribution. And depending on the provider, you may have a range of options as to how you can invest. So when it comes to direct contribution pensions, it really does depend on a number of factors. Firstly, how much money you'll contribute, and for a number of women this is actually linked to your employment, and the gender pay gap can impact on this, and also how well the actual investments have performed, so how the pension pot has performed.
Thanks, Bronwyn. So Rachel, speaking of investments, why should women be concerned about what their pensions are invested in?
Well, what it's invested in will determine how much it will be worth in the future, and that will determine when you can retire and how much per year you will receive in retirement. So it's really, really important. At the very least, you want your pension to be matching inflation. At the moment, inflation in the UK is running at quite a high level. It's running at 3.8% per year. And if you've got money in a cash savings account, you'd be lucky if you're making 0.5% per year. Most of us are probably making 0.1% or even 0%. So if you've got your savings in your pension left there in cash, maybe you think you're being quite safe by leaving that money in cash, but actually if you're earning no interest and inflation is running at 3.8%, then really you're losing 3.8% per year in real terms. So personally, I don't think that cash is the right place to be investing your long-term savings. On the other hand, if we look at the stock market, that has gained over 20% over the last 12 months. So that's well ahead of the rate of inflation. It has been a particularly good year for the stock market, so we can't obviously guarantee that that's going to happen every year. But historically speaking, the stock market has generally gained about 6% per year over and above the rate of inflation. So the long-term returns for the stock market have been very good. As Bronwyn said, we do like to use quite a lot of lingo here in the financial services industry. And one of the ones we like to use is asset classes. And that really just defines the different types of things or investments that you can buy in your pension. So cash, for example, would be one asset class. Another one would be stock, shares, or equities, all the same thing, just using different words. Another one that's quite popular with pensions is bonds. So whereas a share is when you buy a part of a company and you become a part owner of that company, and as that company grows, you ideally hope that the value of your share would grow as well. A bond, on the other hand, is when you lend money to a company in return for a fixed rate of interest. So bonds are considered to be less risky than shares, and therefore they can be quite popular for pensions, particularly as people do reach the age of retirement. But I'm just going to show you some data here that shows you the long-term returns for these different asset classes over a very long time period. So this data goes back to 1899. So we've got more than 120 years of data here. So unfortunately, I doubt any of us will be able to invest for this long, but it's still quite interesting to look at the data. So here we go. So we've got the stock market in the blue. So you can see that has performed incredibly well over this time period. And then in the light blue and the green, we've got gilts, which are UK government bonds. And in the green, we've got T-bills, which are US government bonds. So you can see that over this very long time period, the equity market has far outperformed the bond market. So if you are a long-term investor holding investments in a SIPP, then you are likely to get a much better return from investing in stocks and shares. And this is particularly relevant to women, actually, because a lot of the studies have shown that women tend to have less money in their pensions, as Sarah mentioned in the introduction to this webinar. There are many reasons for that, but one of the reasons is that historically, women have tended to take less risk than men, so they haven't had quite the same investment performance. And I'm just going to show you one more slide that illustrates this. So this is some data that was put together by the ONS, which is the Office for National Statistics, and it shows the different levels of pension savings that men and women had. The data goes back to 2018, that's when this was put together, so it's a little bit out of date, but I still think it's very relevant. And so it shows the different amounts of pension savings that men and women of different age groups have had. So if we look at the ages 16 to 24 and 25 to 34, you can see that those two age groups tend to have quite similar pension savings between men and women. Whereas after that point, a very, very big gap starts to develop. And by the time we get to ages 65 to 74, the men on average tend to have more than twice the amount that the women have. And yes, there are lots of different reasons for this. One is that men have historically earned more. Clearly, women are more likely to take time out of work to raise children. But the report does specifically highlight that one of the reasons for this big gap in pension savings is the fact that women have historically taken less risk. So I think that's quite a good warning not to have too much of your long-term savings left in cash. I need to stop sharing my screen.
Thanks ever so much, Rachel. So Bronwyn, when should someone start to think about their pensions and what will they need?
So the earlier the better. I think Rachel's just explained too that it's time in the market. So what I thought I'd do is visually show you an example of working with a client to work out how long her pension pots may last, and the changes in that we made and the impact that it made on her pension pots. So just let me quickly share my screen, and let me go there. So this is a client. The client is 45 years old. She's been working for 20 years. She's single. She owns her own flat, but she has a mortgage with 10 years to go on it. And this is what we call a cash flow model, which we use with clients. On here, I'll just explain how it all works. Is that you can see that she's decided that she wants to retire. So this is pre-retirement. This is when she's working. She's decided that she wants to work up until 65. And the reason being is that she's got a final salary pension that she wants to start drawing on. And then the second part is obviously her life after work. Let me explain about how these all work. So you can see here that this is her expenditure line. She stops paying her mortgage, so she's paid it off at age 55. And then this is into retirement, how much she's going to need. Now, at the end here, you can see that this really spikes up. And this is the last 5 years of her life. We go through to age 95. And what we do here is that we make sure that we've got enough money for care later on in life. So this is 3 years of residential care and then a couple of years of nursing home care. Now, this client, she is earning $75,000. She has expenditure, including her mortgage, of about $35,000. Her state pension, now this will start here, and I said earlier that younger people obviously will need to work a lot longer, so she needs to start working right up until age 68. But you can see here that the pension, the state pension, makes up a bit of her pot there. The second bit is she's got a final salary. It's a very small one. She only worked for a company for a couple of years, but it gives her $5,000 every year throughout retirement, and that is increased with CPI, with inflation as well. So you can see here that it starts at age 65, then the state pension kicks in, so she's got this right through. This client also has about 3 other pensions with different providers. Now, these are old workplace pensions, so she's moved around a couple of times. And these are in this light blue here. Now, as Rachel explained, she's actually got those invested. A majority of them, she wasn't too sure what to invest in, so she wasn't sure about the stock market. So she's pulled back a lot of the risk on these, and all of these are invested in non-equities, so they're invested mainly in bonds and bond funds. So you can see here that this starts paying her out some money throughout her retirement. The green here is that she has a couple of ISA stocks and shares, so she did want to start dabbling in investing. So she's got a little bit of stocks and shares that which will pay her some money, but you can see there that she's actually got this shortfall. And this means then that she's still got one of her main assets. So she has her flat, and that's worth $400,000. She's paid it off, so there's no mortgage. But you can see there that for her to afford this cost of care at the end of her life, she'll need to sell her flat. And this is something that is actually quite important to her, that she really does want to leave something for her nieces and nephews. So she wants to make sure that she can cover her cost of care later on in life, but she really doesn't want to sell the flat. If she could, at any stage, she would like to leave something for her family going forward. Let me just move this on. I won't be a minute now. So the second graph is basically explaining what we actually did for her as well. So firstly, what we did was we consolidated the 3 pensions that she had elsewhere, and we moved them on to what we call an equity growth risk approach. Because she's got over 20 years, so she's got from now right through before even starting to draw on those pension pots. We wanted to really build up the fund for her, so really making them work hard. We only slightly increased her pension contributions, which basically means that all now of her expenditure, so not only throughout her retirement, but all of her cost of care is now met by her pension pots. And what it does is it leaves her the opportunity of, she's still got her flat when she goes into care, but she also leaves a balance in her SIP as well, which she can then pass on to her nieces and nephews. And that basically means that the SIP sits outside, so pensions sit outside of your estate when it comes to inheritance tax. So she's actually saving there as well. So let me move on. So looking at them, and it might be a bit small to see, but a comparison between the two, what we've been able to do is make sure that she's covered her cost of care, all of her retirement, and also saved a bit of money there for leaving that to her family as well. So her flat and her SIP as well. In her review next year, she's really interested to actually start increasing those pension contributions. So making use of this additional money that she has, which for her, a majority of it, she does save a little bit each year, but she's actually spending a great deal of her surplus cash as well. So she wants to put together a bit of a savings plan for next year and looking to utilise her ISA allowances there to give her a little bit of flexibility as well. So with the cash flow models, it's not only pensions that we can use. We can also include things like buy-to-lets as well, because some people have portfolios that they want to use to actually pay for life after work in their care later on in life. So we can include all of the assets here as well. So let me just stop sharing here.
Thanks, Bronwyn. Looking at the cash model was really interesting. So Rachel, why should we try to start early with our long-term savings?
Well, many reasons. As I said, here in the finance industry, we love lingo. And one of our favorite words is compounding. So this simply means that your investments will be earning returns on their returns over long time periods. So for example, if you're starting with £100 and your portfolio is growing at 5% per year, in the first year, you'll get a return of £5. And at the end of that year, you'll have £105. The following year, you'll be earning 5% of £105. So your growth will then be £5.25. And it carries on and on and on. And every year your gains will get bigger and bigger and bigger. And that compounding effect will really have a big impact over long periods of time. So the earlier you start, the more you will benefit from this so-called compounding effect. Another reason is that if you start early, you can afford to take on more risk. And the main reasons for that is that if you're investing in a pension and you've got more than a decade, for example, until you need to take the money out, then if the market crashes, you've got plenty of time to wait for that market to come back before you would need to take out that money. So the crash in the market actually wouldn't impact your lifestyle whatsoever. And then the final reason is that the earlier you start, the less you will have to put in every month to get to your target retirement pot size.
Really good point. Thank you, Rachel. And how can people take more control of the investments within their pensions?
Again, many different ways. So as Bronwyn mentioned earlier, you have got the opportunity to consolidate some of your old pensions. And I think this is a really important thing to look at because it's very common now for people to move jobs every 1 or 2 years, for example. And we've seen people with 14 different pensions all over the place, and they're all tiny, they're all in kind of little bits and bobs all over the place, and it's impossible to keep track of that and to know exactly how each one is invested. So I think the simplest thing to do is to move as many as possible of them into the same place. So then you've got as much as possible of your pension savings in one location, and you can have one coherent investment strategy for the whole lot. The next thing to do is to consider what type of investment service you have for your pensions. And for us, there are 3 different types of investment service. So the first one is called execution only. And that's where you're an expert in investments, you know exactly what you want to buy, and you just need a platform to execute those orders for you. So if you want to pick your own investments and you don't want any advice, then an execution only service could be the right option for you. You've then got advisory investment services, and that's where an investment advisor will have a chat to you about what you're looking to achieve, when you want to retire, what sorts of things you want to invest in, and they will give you advice on what investments you could buy for your portfolio. And then the final service is managed or discretionary. And with this one, again, you would have a chat to an advisor about what you're looking to achieve, and then that advisor would manage the portfolio for you on an ongoing basis. So a great way to take control is to move all of your pensions into the same place and make sure that the whole lot is on the right service for you. I would also consider, for example, if you have a workplace pension, so it might be an employer that you're currently working for and contributions are going into a pension for you. Have a look and see exactly what sort of investment the contributions are going into, because often all of the pension contributions will go into one sort of one-size-fits-all default fund, and that fund might not be the right one for you. It might not be the right risk level, and something that we're hearing a lot about at the moment is that people have quite clear ethical views of how they want to invest, and it might be that you're in a fund that doesn't necessarily fit with those ethical views. So those are some of the ways that I think you could start to take control of your pensions.
Great, thanks ever so much. So Bronwyn, back to you. When should someone actually seek advice, and who should they seek advice from?
Basically, when things start to get complicated for you. Now, this may include, like Rachel said, if you've got a number of pensions or different types of pensions. So if you've got that mix between the direct benefits and the direct contributions, and you'd really like to look at consolidating that, it's really important to seek advice at that stage. Where you'd like to make additional contributions on top of the basic sort of workplace pension. Now, you may have additional funds, you may be building up some cash savings or have an inheritance or maybe a bonus which is coming through. And this involves basically looking at previous year's allowances and using a method called carry forward. There's a number of different conditions and restrictions around here, hence needing advice. Another situation is where people are coming up to actually finishing work and wanting to look at what the best drawdown strategy is, or which pots or pot of money should they use first, which is most tax effective. And, if they're not already working with a planner, it's a really important time to actually start looking at that. And that's also too, so the pension freedoms began sort of around 2015, and people can take tax-free cash. It's really important to actually start looking at what that strategy is. Another term you may have come across is the lifetime allowance. And this is a cap as to how much individuals can actually contribute to their pensions. Why this is complicated is that the limits have changed over the years. They've gone up and they've come back down, and there's a huge number of rules as to ascertain what somebody's LTA charge or position actually is. We may look to cover this in a future webinar when we actually start looking at some of the different drawdown strategies once you've actually stopped working. We also have a whole lot of, it's probably a good point just to bring that up now, we have a whole lot of useful guides when it comes to, and we'll mention these at the end and send out the links afterwards, because we've got all of these guides that will really help explain some of these terms and the jargon as well, and when it's important to actually seek a professional advice. We've talked a lot tonight about sort of employed people, and my example showed somebody who was employed. But when it comes to the self-employed and business owners, they have a lot more flexibility and control over their income. So there's more opportunity for planning and actually seeking advice at this stage. And the final area is where a situation where people might want to use their private pensions to pass down wealth to other members of their family. They might not need it, and they want a really effective and tax efficient way of passing that on to other family members. So I showed in the cash flow model where the client basically had pension funds remaining at the end of her life, and she wanted to make sure that she could pass that on. So there is a savings from an inheritance tax point of view. So it's important to seek advice. Now, you're asked to who should you seek advice from? So it should be a financial planner such as myself who will be able to help. Some of the areas that I've mentioned really require sort of a technical expert, such as a pension transfer specialist when it comes to a direct benefit pensions, or a trust expert as well if you're starting to look at IHT. And as we mentioned in a couple of the other webinars, there are a number of different titles when it comes to advisors. So it's really important to understand when you're speaking to somebody what advice they can give and what they're qualified to give as well. So just ask the questions. Majority of people will offer a free consultation at the beginning. So make sure you do ask.
That's wonderful. Thanks, Bronwyn. And Rachel, is there anything else that you think is relevant?
Yes, so I was just going to mention ethical investing, because this is something that we're getting lots and lots of questions about. It's becoming incredibly popular, which is definitely a good thing. But the issue is that there's no specific definition of it. So all providers are using their own different definitions. And also, I think ethical investing is quite subjective. So what's ethical to me might not meet with your views of what ethical is. So when you are selecting investments for your pension and you come across a fund that labels itself as ethical, just have a quick look at it and just make sure it does align with your values, because there are lots of so-called ethical funds out there that, for example, contain lots of oil and gas shares, and that might not align with your view of what ethical should be. So just have a look at the detail of what's deep down in those investments and just make sure that they are indeed right for you.
Great, thank you. So Bronwyn, for someone who's getting started with reviewing their pensions, where should they actually start?
So for everyone on the call tonight and everyone, we should be viewing our pensions as a way of looking after our future self. So I think a lot of people get very concerned about their money being locked up for a long period of time, but do think about it as looking after your future self. If you're just starting out, you're just starting your work life now, ensure that you've been enrolled in your workplace pension, and where possible, start thinking about making future contributions. Now, this does need to be balanced with your future goals. So you might need sort of a larger fund down the track for buying property. So it's just important to balance those needs as well. The next place to start is really thinking about, and I mentioned it earlier about your state pension. There's never too early a time to actually start looking at that, and I've popped the links in the chat there for you as well. So start thinking about when you're going to be eligible to draw your pension, and whether you've got any gaps that may need to be topped up. Then it's really important to start reviewing your existing pensions. If you've worked for a couple of employers, like Rachel said, people are tending to move around a little bit more at the moment. So if you do have these sort of smaller pots around, you do need to keep track of them. And I've put the link in the chat as to how you can actually start tracking those. And then it's all about, and like Rachel said, it's about understanding what you're invested in and are there any changes that need to be made. Also too, when we're looking at reviewing our existing pensions, it's also important to look to see if you've actually completed what we call an expression of wishes or a nomination form, so that the pension provider knows who you'd like your pension to be left to. That's really important, and it does come down to, maybe your longer term plans as well, and how you'd actually like to sort of leave your estate for family as well. And then at this point, it's about reviewing these regularly and seeking advice when required.
Okay, that's great. Thank you ever so much. So, Bronwyn, really, what is your takeaway for everyone this evening?
I think the biggest thing to take away is invest in your future self, locate and review what pensions you already have. And one point to note, and the reason why we put this webinar in December, is if you are looking to make additional contributions in this tax year, start the process now. So start now. Don't leave it until the end of the tax year, so like February or March. Professionals, accountants, everyone is thinking about that tax year end. So it's important to have the discussions now.
Well, thanks ever so much. And Rachel?
I'd go back to that point about risk that I made at the start. So I've had so many people saying to me, am I taking too much risk with my pension? And that is a very important question. It's one that you should be asking. But I don't think I've ever had anyone say to me, am I taking enough risk? So I think you need to ask both questions, because there is a risk that if you're not taking enough risk, then you won't get the return that you need to retire when you want to retire.
Okay, that's wonderful. Thanks ever so much. Well, thank you both for your insights. Now we've got some time left for some questions. So if anybody's got any that they haven't already put forward, and I can see that we've already had a few, please do send them through now using that Q&A button on your screen. Let me just start here. So I've got one here. I think this one's probably for both of you actually. If I received a cash gift, how do I decide whether I should invest it into my pension or elsewhere? So Bronwyn, what would you say?
So I think firstly, it depends on sort of what stage of life that you're in, and I guess your end goal. So how close you are to sort of finishing work. Is it, do you sort of do need to top up your pension? So that would be a natural sort of place to put it. Or are you thinking about sort of passing it on to loved ones? And again, you know, the pension side might be quite relevant, but it really does depend on your sort of personal circumstances, how big your pension pots are as well, things like how close you are to the lifetime allowance as well. So it is important that it very much does depend on people's sort of personal circumstances.
Okay, thank you. And Rachel?
Yeah, and obviously this is a webinar that's largely based around pensions, and they are great as a vehicle, but it's important to remember they're not the only option. And for example, these days we have stocks and shares, ISAs. The allowance for those has been increased hugely over the last few years, and you can now put in £20,000 per year. They're also very tax efficient, and they do give you more flexibility than pensions because you can take out the money whenever you like, rather than having to wait until you are a certain age. So they're definitely worth a look as well.
Lovely, thank you. So there's one here. There's a question. I don't know if how much detail you'll be able to go into, Bronwyn, but it says here, as a sole trader, I don't have much in workplace pensions, a couple from the past. What guidance do you have specifically for self-employed?
Yeah, so I think for the self-employed and those who have got who've set themselves up in business, it is really important, firstly, to locate some of those ones that you've had in the past as well, and then to start looking at making your pension contributions. So you've still got your annual allowance every year, so you do need to factor that into the equation as well. Just because there's not a sort of a set employer contribution, it's not a reason not to make your pension contributions, and of course then you do get your tax relief as well. So it's important to sit down and look at it from a business perspective. Obviously, if you do make pension contributions on behalf of a business, then there is a tax deduction there as well. So there is quite a lot of benefit of actually looking at pension contributions, but I would always say make sure that you have that discussion with your professional advisors. So sit down with your accountant, look at what you can actually afford as well, and then sit down with a planner who can actually look at structuring those pension contributions.
Okay, thank you. So there's a question here. So broadly, Bronwyn, what are the tax relief saving options for pensions in the UK?
Yeah, so broadly speaking, your reliefs are at 20%. So that's not only just for those who are employed or self-employed or own businesses as well. You can actually make pension contributions if you don't earn as well, and so you can make a pension contribution a net amount of up to 2,800, and then you're topped up with the 20%, so you actually end up getting 3,600. So it is important that even if you aren't working, that you're making those sort of pension contributions, because you do get the tax relief there as well. So for basic taxpayers, obviously you're getting 20%, and then higher earners as well. Basically, you can get tax relief as well. So it is important to look at making those pension contributions.
Lovely, thank you. Someone has commented here. This is a great illustration. I assume this means the cash flow model, but what happens if you don't own or can't afford to buy a property, which will be difficult for many people?
Yeah, that's really quite important, and I think for a lot of people they're finding it quite difficult getting on the property ladder. So the illustration does show somebody who does own their own property, but it would be exactly the same we can strip that out and actually have somebody who's renting for the rest of their life as well. what we'd do then is just increase the expenditure there to cover rent. So again, you'd look at your pension pot and make sure that you were actually covering that. And I think that's probably really relevant with the first example, which I showed you, that the person was potentially relying on having that property there. So you've just got to then make sure that you are really planning for the future.
Okay, so the cash flow model works whatever your circumstances are, really, then? Is that what you're saying?
Absolutely. And I sort of, at the end of that, I sort of said, you can put in other assets as well.
Yeah.
So there might be other things as well. So you might have just a general investment account. I didn't touch on those, but there's different ways and means of actually putting in different assets so that it actually shows what your position is going to be in
Thank
the future.
you. There's a question here: can you not take a direct benefit pension and leave its lump sum value to beneficiaries without paying IHT?
So we're starting to get into an area where so the direct benefits are pensions. It's can be quite difficult. So I might park that one and come back to the person directly on that one.
Okay, lovely, thank you. And this one's for Rachel. Do you have details of market crash cycles over time, and are they fairly regular?
They are unfortunately fairly regular, but at the moment the market is pretty close to a record high. So that tells you that the market has recovered from every single crash that has ever happened. The most recent crash would have been March 2020, when we first went into lockdown. At that time, the market dropped about 30%, but it did recover very quickly. And the one before that would have been the Great Financial Crisis, so 2008. And the one before that would have been the dot-com crash around about the year 2000. So generally, I suppose some people might say they happen every 8 to 10 years, but it's definitely not that regular or that predictable.
Thank you. There's a question here. I don't know if we'll be able to answer it or not. What if I have state pension contributions in more than one country?
So it very much depends on whether there's any sort of reciprocal agreement between the countries. And what tends to happen is that there will be one country that sort of pays out the state benefit. And if there is then a reciprocal agreement, they will then, I guess, take that money from the other state. So it does get quite difficult if there is sort of whether or not there is a reciprocal agreement. But so it is something to really start looking at and seek advice on. It also depends, if you are moving between two different countries and contributing in different ways. It very much then depends on like I said, the difference between the countries. So if you compare the UK with other markets or other countries, some will have a state pension, but it might be means tested. Others might just have a universal state pension where everyone, if they've been in a country or if they've paid taxes, will receive payments. So it is really important to seek advice, and again, it will depend on the reciprocal agreement between the two countries.
Okay, that's great, thank you. There's a good one here. It just says, would you be able to run a future session on investing in terms of setting up your own portfolio and how this might be done, e.g. suggested platforms, understanding the difference between asset classes and how to go about it? This is really useful because we have been talking about future topics for webinars. I don't know if you've got anything to add to that, Rachel?
Yeah, just to say absolutely. So just before this webinar, we were talking about what our next one could be, and we said we'd like to do one that was a bit more investment focused. So stay tuned, and we'll definitely do one in future.
Thank you.
And also too, we're looking to do that in the new financial year as well, so the new tax year. And the reason being is that we want to make sure that people have got all of the options, but also too, that's when all the allowances. So your ISA contributions, you can start that again as well. So.
Okay, I've still got several more questions, but we're getting close to time, so I'll just ask one more if that's okay. So apologies, we haven't had time to answer everybody's questions, but any that we haven't answered this evening, we will follow up by email. So I'll just finish with this one. I had several jobs in the 1970s and haven't been able to trace any pensions from them. Is it likely that I just didn't contribute to any pensions?
If you've used the link and you've gone through and you've tried to track them, then it could be that that there wasn't anything set up, so they didn't need to necessarily pay you pensions. So it might be that there weren't any, but I would definitely use the government link and try and track them down if you possibly can.
Okay, that's great. Thanks ever so much. Well, thank you for all of your questions, and obviously thank you to Bronwyn and Rachel, but we have to wrap things up here now. Obviously, as I've mentioned, if we haven't been able to respond to your specific query this evening, we will follow up separately by email, and everyone will be receiving a follow-up email as well that will contain a recording of this evening's webinar, just in case you want to watch it through again, in case there's any points that you've missed. And that email will also contain some additional useful materials, and there'll be a short survey in it, and we really do love to hear what you think, so please do complete it. So we hope you've enjoyed listening to our speakers this evening. We'll be hosting further webinars, as we've mentioned, in our Financial Wellbeing for Women series in the next financial year. And for now, I hope you enjoy the rest of your evening, and it's goodbye from us. Thank you.
Thanks everyone. Bye-bye.